Let's drill down now into these markets with Junbei Liu, the manager of Tribeca Investment Partners Long Short Fund. Now, Junbei, an investor like you can sort of make money no matter whether the market's going up when you're long side of your fund or down with the short side of your fund. But with markets at record levels, you normally would be looking for opportunities on the short side of your fund because you know the prices are very, very high. So is that the strategy you're adopting right now, or are you waiting for this market to have an even longer run? How do you look at this? Yeah,
look, this is a really good question. And long-short managers generally outperform, throughout any type of market condition. They do much better than long-only sort of managers because of our ability to short. Now, when market becomes more and more expensive, we just see more and more opportunity on the short side of things. Now, they may be from sectors that's becoming increasingly expensive, and we can find short opportunities there, or they may be coming from sectors where potentially earnings expectations too high as the market becoming more frothy.
Okay, so is it a case where a manager such as yourself will say, right, the overall market's too high, we're going to short the market? Or is it that you, in these short selling opportunities, look for the individual stocks, as you've mentioned, that have either gone too far or simply are not justifying the earnings that are behind them?
Yeah, that's a really good question. For a good long-short managers, they should always find stock specific. So find companies that have issues, gone too far, a company itself rather than the whole market. Shorting the market is very, very dangerous because, think about what's in our index. It's the banks, it's the resources companies, it's the Afterpay, it's the CSL. So these are very high quality businesses. So if you decide to short that, you essentially saying all these companies are going to do very, very poorly. So I think that's a very risky short. Always find the companies that has earnings issues or have just simply gone too far.
Okay, so the reason you look for companies that have the earnings issues, and we see them literally on a weekly basis, they come out with a profit warning or some sort of a profit downgrade, and all of a sudden the market's not expecting it. Maybe there's short sellers in there as well, but all of a sudden the price falls by 20, 30%, 15% of something of that nature. We talk about them all the time on this program. So from that point of view, that would be the type of situation that would be really important for a fund such as yours, especially on the short side of the portfolio.
Absolutely. This is how we make most of our return, really. That's the bread and butter for a long-short manager. We find those companies, we identify what the next earnings expectations will be, we identify catalysts of when it might take place, and then we build our position. And when the earnings catalysts come through, we make 30%, 40%, sometimes 50% in that one trade, and we look to close it. And remember, when we short those companies, we get the money that we can use to buy more of the companies we like, by more of the companies we think are going to deliver, outperformance relative to the others. So, on that basis, we actually magnify our returns from both sides of the book.
Okay, so then in the United States, of course, a lot has been said in this last, 6 months or so about the meme stocks, about the likes of the GameStops, about the AMCs of this world. Now, here in Australia, we haven't seen that, where short sellers such as yourself are taken on by people, retail investors, who kind of like that company, who don't want that company to fail, don't want its share price to keep going down. Is there a point at which you expect to see that sort of, if you like, aggravation in the market happen here as it has in the United States?
Look, I don't think Australia will see that to that extent. So we have seen a little bit this year in January and February as a result of what's happening offshore. Now, in Australia, the retail market, retail investor base is much, much shallower compared to what the US market is. So that simply means that retail investors as a group collectively are as large as what it is like the offshore. But it is increasingly becoming more important. Now, this is the key as a long-short manager, run a very long-short fund, is that we run a very diverse short book. So we don't have a concentration risk of one stock suddenly double and then hurt your performance. So during those periods when a lot of heavily shorter stocks that rally in January and February, we've done incredibly well because we actually bought a lot of those businesses because we see them as very too cheap to be shorted. So it's all about actively finding opportunities in, where the company is going to fall or whether it's going to rise and position relatively.